Most people think investing is only for the rich, the financial experts, or the lucky few. But the truth is, the earlier you start investing, even with just $10, the better your chances of building lasting wealth. And no, you don't need to be a math genius, a stock market wizard, or glued to your phone all day. Saving is important, but it's not enough anymore. Why? Because of inflation. When inflation rises, your cash loses value while prices go up. If you save $1,000 in a bank earning 4% interest, but inflation is 6%, you're losing purchasing power every year. That's why the wealth gap keeps growing, not because rich people save more, but because they invest. Investing allows your money to grow faster than inflation. It's how you build wealth over time, prepare for retirement, and protect yourself from future uncertainty. If you want financial freedom, investing is no longer optional, it's essential. Investing simply means putting your money into something that has the potential to grow in value or generate income. You're giving up the ability to use that money today in exchange for more money tomorrow. It could be a stock, a bond, real estate, or even a side business. But the key principle is this: your money should be working for you, not just sitting in a savings account. Investing involves risk, yes, but it also offers reward. And the longer your money is invested, the better it works. Think of it as planting seeds. You won't eat the fruit tomorrow. You wait, water it, and let time multiply it. Albert Einstein reportedly called compound interest the eighth wonder of the world, and for good reason. Imagine investing $1,000 with a 10% annual return. After 1 year, you have $1,100. But in year 2, you earn 10% on $1,100, not $1,000. That extra $10 in year 2 is interest on your interest. Over time, this effect becomes exponential. After 20 years, your $1,000 becomes $6,700. After 30 years, over $17,000. And all you did was stay consistent and give it time. Starting early isn't just better, it's everything. It gives compound interest the time it needs to build your real wealth. As a beginner, it's important to understand the basic types of investments so you can make informed choices. Stocks represent ownership in a company and can offer high returns over time, but they also come with higher risk. Bonds, on the other hand, are loans you give to companies or governments in exchange for interest. They're generally safer, but grow more slowly. ETFs, exchange-traded funds, are beginner-friendly because they bundle many investments into one and offer instant diversification with low fees. Mutual funds are similar but are often actively managed and come with higher fees. No investment is risk-free, not even savings accounts. But the key to success is understanding your risk tolerance. Are you okay with seeing your investments go down in value temporarily if it means they could grow more in the long term? If yes, you might lean towards stocks. If not, you might prefer bonds or a mix. The goal isn't to eliminate risk, but to manage it. Diversifying across different assets helps reduce the impact of any single one performing badly. And remember, doing nothing is also a risk, especially in an inflation-driven economy. Gone are the days when you needed thousands to invest. Thanks to modern platforms, you can begin with as little as $5. Apps like Robinhood, Public, M1 Finance, and others offer fractional shares, meaning you can buy a piece of Amazon stock for just a few bucks. But even more powerful than your starting amount is your consistency. It's better to invest $50 a month consistently for 5 years than to invest $1,000 once and never again. Building the habit matters more than hitting a big number on day one. Choosing the right investment platform depends on your goals and experience. If you want simplicity and automation, try apps like Acorns or M1 Finance. If you want more control, look at Fidelity, Vanguard, or Charles Schwab. Prefer mobile? Robinhood, SoFi, and Public are beginner-friendly. Make sure the platform offers low fees, diversified funds, and educational tools. Avoid platforms that push risky products like options trading or margin loans right away. As a beginner, your focus should be on long-term growth, not short-term gains. If you're overwhelmed by which stocks to pick, don't worry. Most pros can't beat the market either. That's why index funds are ideal for beginners. An index fund tracks the performance of a broad market index, like the S&P 500. It spreads your money across hundreds of top companies, giving you instant diversification. They have low fees, require no effort to manage, and over the past few decades, they've outperformed most actively managed funds. If you only ever invest in index funds and stay consistent, you're already ahead of 90% of investors. Investing is not about getting rich next week. It's about building wealth over years and decades. Markets will rise and fall. You'll see red days and green days. But what matters is that you stay the course. Don't let fear drive you out of the market or greed tempt you into risky bets. The most successful investors don't chase trends. They stick to a plan and trust the process. Think long-term, ignore noise, and keep investing through every market cycle. When building your first investment portfolio, keeping things simple is the smartest approach. A great foundation for most beginners is to invest the majority of your money, around 60 to 70%, in a broad total market index fund or ETF, such as VTI or VOO, which gives you exposure to hundreds of companies in one place. Then, to add stability, you might allocate 20 to 30% of your portfolio to a bond fund or target date fund, which is designed to reduce risk as you get closer to your financial goal. Every new investor makes mistakes, but avoiding the biggest ones can save you time, money, and stress. The most common? Trying to time the market, buying high in excitement and selling low in panic. Others include going all in on one stock, chasing hype or social media hot picks, and ignoring fees, which quietly eat into your returns. Some people invest without understanding what they're buying. Don't be that person. Always do a little homework, and never invest money you might need next month. Investing is not gambling, and the sooner you treat it with respect, the sooner it rewards you. Before investing seriously, you need a safety net. That means building an emergency fund with at least 3 to 6 months of expenses, held in a high-yield savings account, not the market. Why? Because life happens. Job loss, car repairs, medical bills, and if your money is tied up in the market, you could be forced to sell at a loss. Investing without an emergency fund is like driving without a seatbelt. It might be fine most of the time, but when trouble hits, you'll wish you had it. Financial stability comes before financial growth. Investing without a goal is like getting in a car without knowing where you're going. Are you investing for retirement, a home down payment, or building passive income? Your goals determine how much risk you can take, what assets to choose, and how long to stay invested. Short-term goals, 1 to 3 years, require safety and liquidity, maybe high-yield savings or bonds. Medium goals, 3 to 5 years, can handle a mix of ETFs and stable assets. Long-term goals, 5 to 30+ years, give you the most freedom to pursue higher growth options like stocks. Define your why before you decide the how. The hardest part of investing isn't picking the right stock. It's being consistent. Life gets busy, markets get scary, but if you automate your investments and set it on autopilot, you're far more likely to succeed. Use features like auto invest or recurring contributions. Start a monthly reminder to review your finances. Celebrate small wins, like your first dividend or hitting your first $1,000. Join online communities that focus on long-term wealth building, not quick flips. Investing can feel slow at first, but every dollar you invest is a step closer to financial freedom. Yes, because the best time to start was yesterday, and the next best time is today. Don't wait until you have enough money. Don't wait until you know everything. The truth is, the people who build wealth aren't always the smartest or highest earners. They're the ones who start early and stay consistent. Begin with what you have. Learn as you go. And remember, you don't have to be perfect. You just have to begin. The first $10 you invest is more powerful than the next $10,000 you think about, but never do. Investing isn't about beating the market. It's about building your future. It's about creating options, freedom, and security for yourself and the people you love. Don't get distracted by hype. Don't let fear stop you. Just focus on the basics, stay patient, and trust the process.